there's a substantial amount of short selling last week, just as large really as any data point going back to 2010. Good morning. Today's Tuesday, June 21st, and the S&P futures are up about 2%. Now, we have discussed why we were looking for this market rally post-OPEX. We talked about it on Bloomberg News. We talked about it. You can see us on ZeroHedge. You can see us on TastyTrade, and discussing why the market could rally after OPEX due to the closing of big options put positions. Now, if you look at this video, we'll put a link to this video in the description, but we got into the weeds on this. We showed how the June OPEX from a put perspective was nearly as large as the March of 2020 options expiration and why that could drive a rally in the market. So turning back to today, yes, we have rallied nearly 2%, but we're just now back to where we were on the Wednesday FOMC last Wednesday, and we're still about 10% below where we were on June 10th when that hot CPI reading came out. So there's a lot of wood to chop to really call this a material rally. So far, we're just kind of recovering some of the levels again that we visited last week. So what actually happened with options expiration? Well, let's look at this data from the OCC. They aggregate things in a couple of different ways. What we're showing here is the positions by premium. So did people buy or sell to open and close, broken down by option type? That's equity, index, and ETF. And at the top here are the opening positions. So do they buy to open or sell to open? And we want to start with the bottom two slides, which are the covering trades. Surprisingly to us, which is a little bit surprising, I should say, was the buy to cover premium in index land was very high. You can see here this red line again shows us that people buying to close, that indicates they were short to open. They were short puts last week. There's a pretty big covering trade last week. Now, that could have been positioning into the FOMC. We don't know when in the week they covered, but there are clearly a lot of people who were short puts last week that moved to close those. And that was really an index phenomenon, not something that was in equities, which is the gold line, or ETF puts, which is the brown line down here. At the very bottom, we have the sell to close, which is if you were long puts, you would sell to close, obviously. And it's no surprise that there is a big spike there given the June OPEX positioning. So clearly there was a lot going on in the index put land. It was a standout week. Going back again to March of 2020 in terms of size, just as we laid out again in this video here about how big this June OPEX was. Now back to what traders initiated last week at these top two charts. You can see that on the very top, the red line, again, index puts, shows us that the biggest trade was buying more put protection in the index. That is why this red line is breaking out. Again, the biggest level of put buying since about March of 2020. The side note here is equity call buying, just anemic. I mean, we're way down from where we were over the last 2 years where there's call buying and meme mania, et cetera. So that has really dried up. And then the second thing to note here is the selling to open, very big in the indexes, but also look at that gold line. That's the equity put positions, a lot of selling to open there. So clearly there's some people, yes, positioning for longs, but there's a fair amount of people sticking their heads out late last week looking to sell put options. So that's very curious. Now, one other thing to note here as we flip back to the S&P chart, we don't see a whole lot of resistance up until the 4,000 area. We highlighted these two strikes here, the 42.85 and the 36.20. We've been talking about those. Incidentally, if you wanted to see a bigger discussion on this known as the JP Morgan quarterly roll, check out this June OPEX video. We'll put a description to this. We get into this with our friend Imran as to why the JP Morgan strikes are important going into the quarter end. So check that video out. But back to the chart here. There's some room for this market to rally a little bit further, not just off of the put positions as we've described, but note this chart here. I apologize, a little bit small. We pulled this from ZeroHedge, but this is the Goldman Sachs Prime data. So they look at their hedge fund clients and they see what they're trading. And in this case, you can see that there's a substantial amount of short selling last week, just as large really as any data point going back to 2010. So there was heavy short selling by hedge funds in this week. Now, anytime you have from a positional perspective, people shorting heavily, and you can get something like this OPEX-driven bounce, well, that could create a real short cover rally. That could add some more fuel to the fire, indicating that this rally may have some more legs here. We think, again, sparked by this options expiration. Now, we're going to be tracking this every single day. As always, for our clients, we write 2 daily notes. If you're interested in trying those out for free, you get a free 7-day trial. Hit subscribe now, and you can get our daily written analysis that will keep you up to date on exactly how the options positions are shifting around. If you have any questions, please put them in the comment section below or hit us up at SpotGamma on Twitter.